Hi, this is Emmy Pahavera Carpo. I'm a CPA, and today's video is about understanding the debit and the credit of accounting. So without much ado, let's dive deeper into this topic, okay? So, in accounting, all transactions and events are classified into three values, namely the asset, the liability, and the capital. Oh, what in the world do these terminologies here mean? Well, asset is anything owned by the business. For example, cash, merchandise inventories, accounts receivable, equipment, truck, building, land, and many others for as long as it is owned by the business, meaning to say the business has right or title over it. On the other hand, liability is the financial obligation of the business in favor of a party other than the owner. For example, the business secures loan from a bank or purchase its inventories on account. Therefore, the business has a liability or financial obligation in favor of the bank or the suppliers. Of course, the bank or the suppliers are not the owners of the business. They are merely lenders to the business, and as such, they have a claim against the business. Now, let's go to the capital. Capital is the share or equity of the owners in the property or rights on property of the business. Meaning to say, capital is the amount of value that the owner has over the assets of the company. Now, it is under these three values here, the asset, the liability, and the capital, that all the transactions and events of the business are classified into. Now that you understand these three, you are now prepared to understand the most basic accounting equation, which is assets is equal to liabilities plus capital. Assets is equal to liabilities plus capital. If you notice, there are two sides of the equation, the left side being the asset side and the right side of the equation, which refers to the liabilities and capital side. Take note of this accounting equation because it has a direct bearing on the theory of debit and credit. And in order for you to really grasp the idea of debit and credit, you need to understand that in every accounting transaction, there is a value received and a value parted with. You need to understand these two values here because they are critical in understanding the debit and the credit of accounting. Let me give you an example. Let's talk about my sister and I. Let's say that my sister and I have savings in our respective bank accounts. One day I told my sister that I have enough money in the bank to buy for a car which I can use in going to and fro my office. So to make the story short, I bought a car for 1 million pesos. Let's apply now the value received and the value parted with. As I have said, that in every accounting transaction, there is a value received and a value parted with. So, what was the value that I received when I purchased the car? Oh, the value that I received was a 1 million worth of car. And what was the value that I parted with? Oh my gosh, from the bank in the amount of 1 million pesos. Probably I withdrew everything and paid to my car dealer directly, or probably I paid by my credit card account, whatever. But the value that I received was a car, a 1 million peso worth of car, and the value that I parted with was my cash in the amount of 1 million pesos. Now, since my cash in the bank was fully depleted due to my purchase of a brand new car in the amount of 1 million pesos, I did not have money left to pay for the bills that came prior to my salary date, which normally would come at the end of the month. So what I did, I tried to find things in my personal stuff which I can sell so I can have more money. And I found 3 pairs of shoes that I no longer use but still look nice. So I sold it for 3,000 pesos. So what was the value that I received out of that transaction? Oh, you guessed it right. 3,000 pesos. And what was the value that I parted with? Oh, my shoes. I need to say bye-bye to my shoes worth 3,000 pesos at the time that I sold it. But the money was not enough. So what I did, I went to my sister and borrowed 5,000 pesos. And my sister said, of course, because you are my sister, I'm going to give you what you need. And here it is, 5,000 pesos. So I promised her that I will pay her after 15 days as soon as I have my salary. So what was the value that I received out of that transaction? Oh, you guessed it right. Cash of 5,000 pesos. And what was the value that I parted with? Oh, a liability. This time I have now a liability in favor of my sister in the amount of 5,000 pesos. Now, after 15 days, because I'm true to my word and I want to walk my talk, I paid my sister my debt amounting to 5,000 pesos. So what was the value that I received? Oh, a liability fully paid. That this is the cancellation of my liability in favor of my sister. And what was the value that I parted with? Oh, you guessed it right again. My cash of 5,000 pesos. Now, one day, it was my sister's turn. She needed money, and she came to me saying she wants to borrow 10,000 pesos from me. And I told her, of course, because you are my sister, here is what you need, 10,000 pesos. And so, what was the value that I received out of the transaction? Oh, this time, a receivable of 10,000 pesos from my sister. And what was the value parted with? Oh, you guessed it right again. My cash of 10,000 pesos. Now, let's end the story there. Now that you understand the concept of the value received and the value parted with, you are now ready to understand the actual debit and credit of accounting in a business transaction. Let us have an example this time of a normal business transaction that occur in a business organization. Let's have an imaginary company which we will call the Certified B Corporation. Now, let's apply our learnings of the value received and the value parted with. Because you already understood the concept of value received and the value parted with, you are now ready to understand the debit and the credit of the accounting transactions. When we say debit, that is the value that we receive. And when we say credit, that is the value that we parted with. Now you are beginning to understand what is a debit and what is a credit. But for us to understand it more, let us have an imaginary transactions in our imaginary business organization. Let's say that Certified B Corporation was organized and founded by Mr. X. Now, Mr. X invested $1 million to the corporation. So, what was the value received by Certified B Corporation? Oh, yes, cash of $1 million. When you go to the books of accounts of Certified B Corporation, you debit cash $1 million and credit what? What was the value parted with by Certified B Corporation? Well, at this point, I would like to emphasize that when you make entries into the books of accounts of the business, you should be familiarize yourself with the GAAP. G-A-A-P. Oh, what is GAAP this time? Well, allow me to have a minute first to give you some information about GAAP. GAAP stands for Generally Accepted Accounting Principles. GAAP is the set of accounting rules set forth by the Financial Accounting Standards Board or FASB that U.S. companies are expected to follow when putting together their financial statements. Question: is GAAP followed by the Philippine companies and other companies worldwide? Well, the answer is GAAP varies from country to country. In the Philippines, initially our GAAP was patterned after the US GAAP. But in 2005, the Philippines has adopted the International Reporting Standards or IFRS issued by the International Accounting Standards Board. Now, what is the goal of GAAP? In the Philippines, initially our GAAP was patterned after the US GAAP. But in 2005, the Philippines has adopted the International Reporting Standards or IFRS issued by the International Accounting Standards Board or IASB. Now, what is the goal of GAAP? The goal of GAAP is to ensure that a company's financial statements are complete, consistent, comparable, and reliable. I will talk more of this in the succeeding videos to come. At this time, let me just give you an example of GAAP. One particular principle included in the GAAP is the so-called business entity principle. The business entity principle states, among others, that accounting records must be kept separate from the personal affairs of the owner of the business. Meaning to say, the business is separate and distinct from the owners. It has its own affairs separate from the personal affairs of the owners. Now, let's go back to our example, which is the Certified B Corporation. We said that the owner, who is Mr. X, invested $1 million to the corporation. Because ABC Corporation is separate and distinct from its owners, the business should record its transaction separate and distinct from the owners. So, debit cash of $1 million and credit X capital of $1 million. By crediting X capital, this means that the business is recording in its books of accounts that X has right over Certified B Corporation's assets in the amount of $1 million. Now, if you notice, in these particular transactions and to the succeeding transactions that I will be sharing with you later, the amount of debit is equal to the amount of credit. There should never be a moment in time that debit is not equal to credit. Both sides of the equation should always be balanced at all times. Otherwise, there must be something wrong. So the accounting equation in this particular transaction is true. Assets, which is cash of $1 million, is equal to liabilities, which is 0, plus capital of $1 million. Now, let's proceed to our second transaction. Certified B Corporation purchased its inventories on account with YZ Corporation. The term of the purchase is that half is to be paid after 7 days and the other half after another 7 days. So the entry for this transaction is debit inventories. If you use the perpetual inventory method in the amount of $500,000 and credit liability YZ Corporation $500,000. So, 7 days later, Certified B Corporation paid half of its account with YZ Corporation in the amount of $250,000. The entry would be debit liability YZ Corporation $250,000. By debiting liability YZ Corporation, this means that you are reducing the original amount of $500,000. The original amount, which is a credit of liability YZ Corporation $500,000, is deducted by debiting this amount. So debit liability YZ Corporation $250,000 and credit cash $250,000. So let's proceed to the next transaction. This time, Mr. X asked his accountant to pay for his personal credit card account in the amount of $10,000. The cash will be taken from the cash account of the business. Well, as I said, the business entity principle dictates that the owner's personal affairs are different from the affairs of the business. So the accountant the accountant should record a withdrawal from the owner's contribution or owner's capital. Debit X capital $10,000 by debiting X capital of $10,000. This means that you are reducing the original amount of X capitalization in the amount of $1 million. So you debit X capital of $10,000 and credit is cash of $10,000. So again, you will notice that the amount that you record on the left side of the equation is equal to the amount that you record to the right side of the equation. The debit amount should always equal the credit. This is so-called the double entry accounting. This requires that every business transaction be recorded in at least two accounts. One account is a debit and the other one is credit. And so, with those examples that I gave you, we can now officially define what is debit and what is credit. Debit means an increase in asset, a decrease in liability, or a decrease in capital. Credit means an increase in liability, or an increase in capital, or a decrease in asset. Now, let's go back to the very first transactions of Certified B Corporation. Let us record our first two sample transactions there. I just put here two sample transactions because we don't have much time. So, for the first transaction, it says there, Mr. X invested $1 million to Certified B Corporation. What is the accounting entries for this transaction? Accounting entry for this transaction. Okay, so let's go to the books of accounts of Certified B Corporation for their very first transaction. So, debit cash $1 million and credit X capital $1 million. Now, for the second sample transaction, Certified B Corporation purchased inventories on account with YZ Corporation. What is the accounting entry for this transaction? Okay, so when we go back to the books of accounts of Certified B Corporation for this second transaction, debit inventories of $500,000 and credit liability to YZ Corporation $500,000. So the accounting equation serves as an error detection tool. If at any point the sum of debits does not equal to the sum of credits, an error has occurred. The purpose of double entry bookkeeping is to allow the detection of financial errors and fraud. So that's all for today's video. And if you like this video, please subscribe and hit the bell button so you will not miss our next videos. Thank you.